An investor nightmare is imminent. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today on market, Shockwave threatens to send global stocks crashing, and this comes at a time when most people are fixated on U.S. equities, which are looking to break out to even new highs. And we're going to take a look at the risk in the U.S. equity markets first, and then I'm going to show you where this shockwave is originating and just how it could send global stocks crashing. Now it's over to Bloomberg, where we picked today's story up with a headline. Al Arian says markets have overpriced the speed and depth of the Fed cuts. And this is one of the first issues we're looking at here, is many people have been piling into stocks based on the fact that they believe the narrative of the central bankers that we've achieved a soft landing, and it's only a matter of months from now that a little bit of trimming in the federal funds rate will keep the U.S. economy screaming, and with that sends stocks higher. But it's the unforeseen risk that most people are missing out on. I do think that we get to the pivot, but relative to what the market expects, it won't be as fast or deep. This from Al Arian, the president of Queen's College in Cambridge. I wouldn't be surprised if we start later, probably the beginning of the summer, and I wouldn't be surprised if we end the year with cuts that are closer to what the Fed has signaled, which is 75 basis points, as opposed to what the market is priced in. So here you see someone buying into the view that the Fed has got this right, and yet throughout history, we could look every time the Fed begins to cut, or at least they think they're going to begin to cut, they end up going through a massive cutting cycle, chasing rates to a new low level. And sure enough, the evidence of that is clear in the bond market as we look to the yield curve for answers to where the Fed's really going here. And we can look at the federal funds rate against the yield curve, which is a 10-year, 2-year. Now just hang tight, because we're going to look at the relationship between this and U.S. equities, and you're going to be outright shocked to see that at a time when most people believe that U.S. stock prices can go higher, and they may in the short term, that the risk now is squarely to the downside. Because here you can see the yield curve, when shown inverted, when the red line is underneath that horizontal black line, well, it signals that the Fed is indeed on the cusp of a large cutting cycle. Now let's look at this. Let's invert the yield curve here, which again is shown in red, and you can see that going back as early as the late 80s, the yield curve was leading the federal funds rate lower. Prior to that, they were more in sync when the Fed did actually have control of the bond market, but that went away in the 80s. You can see here, yield curve actually now starting to steepen, again shown inverted, leading the federal funds rate lower. We see that again in the early 2000s. We see it happening ahead of the cuts going in the global financial crisis, almost in sync here as they went down going into the pandemic. And right now, even as the Fed says, no, we're not cutting rates, the bond market is saying in a very loud voice that financial conditions are tightening. And many people believe that when interest rates fall, it means that conditions are easing, because the Fed tells us this is what it means. It means just the opposite. It's telling us that the financial system is starved of money because the banks aren't able to originate enough new loans to keep the growth actually continuing and to pay on all the debt. In that case, rates fall to try to encourage people to come out and borrow. But nevertheless, the Fed continues to be ignorant of what the markets are telling them. As now the Fed could cut inflation as inflation cools and real rates rises, according to Goolsbee. He's a member of the FOMC, not a voting member though. But if we continue to make surprising progress faster than was forecast on inflation, then we have to take that into account in determining the level of restrictiveness. He said we would clearly be evaluating the responsiveness, suggesting that if financial conditions tighten in their mind, which of course they don't actually understand how financial conditions tighten, which is a huge issue here, that indeed the Fed could cut. The Chicago Fed president did not comment directly on the timing of the central bank's first interest rate cut, but his remarks signaled his desire for policymakers, again, he's not a voting member here, to think about cutting rates as inflation falls to avoid too tight policy, again, suggesting there's a link between the federal funds rate and inflation, which we know, of course, there's not. But there is a relationship between the bond market and the equity market, and right now, again, the bond market is screaming the financial conditions are tightening, as investors believe they're easing. And we take a look now at the Wilshire 5000 price index. This is a total U.S. stock market shown in blue against the yield curve in red, which is inverted. We'll continue that from the prior chart. And what do we note? That as the yield curve steepens, again shown inverted, that tells you financial conditions are tightening and leads to equity prices going down, as you see here during the dot-com bubble. Of course, the yield curve led the market going down into the global financial crisis, and now it's doing it again in a big way, and it's telling investors that as you chase stock prices higher, which could continue in the short term, to be very wary. The yield curve is saying bad things are indeed coming if rates continue to fall. But now let's talk about the shockwave that could send global equity markets upside down. This time it's originating in China, which is why we're at the stock exchange at Shanghai. As China's 6.3 trillion stock sell-off is getting uglier by the day. Now, as a trader or investor, you should love to hear things like this because it means opportunities are knocking. The question is, how do you know when a good time to get in? Because if you look at the Chinese equity market, looking at symbol FXI, the ETF, you're thinking, wow, this thing is pretty low here. And the last time it got down to this levels, it rallied over 50% in a matter of 3 months. Talk about what a boom that would be to your trading account or your portfolio. But how would you know? Well, if you signed up for our CTA Timer Pro, which looks at the machine positioning and then runs a historical overlay, it's giving us our golden signal here saying this thing is max short. Now, I talked to the programmer yesterday and he said, look, Steve, I'm still working on it. Hopefully have it all done by the end of the month. That's his target, to show you when the signals flip. Many of you asked for that. Well, we're coming hopefully soon. Gotta get in on this before the change gets through, because here you can see on our Momentum Timer Pro report, this also from today, looking at those technical signals like the RSI and the MACD, and takes all of those signals and smooths them out. It's showing, look, there is an actual sell down here over the short term. We're noticing the 1 month window is about to flip to the downside. This 3 month window is already there. And when that flips in tandem with our CTA program, well, that tells you the probability of a bottom is actually very high. Again, now there's 3 coupon codes for each for a free month. I want you to try it. You've seen many of our other subscribers been super successful. Want you to do that too. Grab a free 3 month when you get there. If there's nowhere to enter the coupon code at the checkout, it's because 3 people beat you to it. But now let's talk about China and this shockwave that's coming, because the equity markets there are selling off in a big way as grim milestones that kept piling up in the recent days, as now Tokyo has overtaken Shanghai as Asia's biggest equity market, while India's valuation premium over China has hit a record. Locally, a meltdown in Chinese shares wreaking havoc on the nation's asset management industry, pushing mutual funds to even close. Now, this is a problem because when people lose confidence in the equity market and the economy, they start to sell, stocks start to go down, and you find that leverage underneath these markets, which the U.S. equity market has more leverage than any other market in the world. This is a big problem. As investors lose confidence, well, all of a sudden, all the rot in the financial system starts to come through. You start to see companies that are basing their valuations and their ability to borrow money on their equity price. They start to fall apart, and this then ripples across the world. And if this doesn't get under containment, well, there's a point where it will get to American shores. As the Hang Seng China Enterprises Index has now lost 11% in 2024, this coming after a record 4-year losing streak, the slump is reinforcing a structural shift that's seen everyone from active money managers to passive funds turn their back on the world's second largest stock market. To me, this opportunity will be coming at some point and in a huge way. But for the moment, this sell down is causing people to run to other places like the U.S. equity market. But if indeed what the yield curve is telling us, which is why I wanted to talk about it early in the show, that financial conditions are tightening, this has every probability of rippling across the world. And again, sending U.S. equity markets upside down. The headwinds buffeting the market are well documented as China's real estate sector remains a trouble spot. The inflationary pressures are building. Of course, here in the U.S., we have disinflation, and a long-running feud between Beijing and Washington refuses to go away, with the U.S. election set to take place later this year. And in recent days, uncertainties about the trajectory of U.S. interest rates, which we've noted now because the yield curve continues to tell us, are actually headed lower. There shouldn't be any uncertainty, but the market believes it, and the threat of an imminent blowout of local stock derivatives, there's that leverage we talk about, have added to investor worries, keeping them away from buying stocks. And China's mutual funds implode now at the fastest pace in 5 years as stocks sink. So here we see domestically in China, the contagion risk is starting to get out of control. You're seeing markets crash. Now we're seeing fund closures. And next thing you know, that's going to keep people, again, well away from buying and maybe looking to sell in other markets. About 240 local funds were liquidated last year, this according to Bloomberg. And that's the most since 2018 when stricter asset management rules triggered a major industry shakeup. Among the closed funds, 4 out of 5 had a stock-focused mandate, which was a record. The trends continued into this year with another 14 funds already liquidated and 24 more warning of imminent closures. So again, all of a sudden, investors now pulling money out like crazy. This is a problem because next thing you know, the system starts to turn down and collapse in upon itself. But for the moment, U.S. investors can't see what's coming from the rest of the world. We talked about how China or potentially Germany could be the catalyst of the next global financial crisis. Well, now you're seeing the Chinese stock markets start to crash, but don't worry, Beijing is stepping in to try to stop it. As China's biggest broker curbs short sales after the stock rout, here we can see state-owned CITIC Securities have stopped lending stocks to individual investors and raised the requirements for institutional clients this week after so-called window guidance. This right from Beijing. They say from regulators, but we know where it's really coming from. Do not let people short this market because we do not want to drive down stocks any more than they are. As people continue to lose confidence, the whole financial system starts to come unravel. We already know that these property developers, they're insolvent. If they go bankrupt, there goes the whole banking system, then the financial system, and then the ripple effect around the world will end with everyone deep in a financial crisis. Meanwhile, Chinese shares have extended declines this year with no signs of a let-up after a harrowing 2023, heading to their worst start to the year since 2016. And while it's not immediately clear how many brokerages are restricting short sales, we'll assume that, well, virtually all of them at this point. The move signals authorities' eagerness to put a floor under the market after earlier efforts, including state buying of bank shares, failed to lift sentiment. So here you can see we've already got some signs that Beijing has stepped in, tried to buy some of the shares, try to keep the markets from falling. The problem is we're facing a global dollar shortage. We're facing a global economy that is slowing and in some aspects contracting. There's nothing they can do to stop this. There's just now we're getting to the point where there's going to be a complete lack of confidence. And when consumers start to see the real estate market fall apart, they start to see demand from the rest of the world decline as their businesses and factories are not running at the capacity they should. They start to see the equity markets fall apart. The next thing you know, they're going to wonder how long their banks are going to be solvent, and people are going to just stop spending, stop investing, and the systems just weren't designed for that at all. In another sign of official attempts to boost stock prices, trading activity in some major exchange-traded funds surged on Thursday, suggesting the plunge protection team in China showed up, buying by state-owned institutions dubbed by the national team at all costs. Keep the markets from crashing here because once again, the markets go, your economy falls with it, and that, again, there begins the shockwave, the ripple effect that starts to go around the world because people panic. They think, if that's happening in China, why can't it happen here in the U.S.? Because you look at the similarities. We have the commercial real estate crisis that just hasn't shown up yet. We know our small and mid-sized regional banks are insolvent. The only difference here is everybody's crammed into U.S. equities, and based on the data coming out of December, U.S. consumers spent big. But just wait. Early signs here in January showing us consumers are dialing back in a major way. We're seeing those builds in inventory from gasoline and distills saying that consumers are now tapped out. If that starts to come to fruition, and next thing you know, people are going to start to wonder if what's happening in China can happen here. And the answer is, you bet. Because now this thing, we look to Chinese bad banks downgraded by Moody's as a situation there gets even worse as Hurong is cut to junk. Moody's action is the latest alarm sounded over the property sector ill's spillover across the economy, despite Beijing's pledges to support policies. And what did we know? That it would not work. And indeed, It's not. This is an issue all about currency. There's just a global dollar shortage. There's local currency shortages. There just isn't enough money to support growth and pay on all the debt. And when that happens, something has to break. The problem is a lot of things are starting to break. It also resembles a sector-wide downgrade by Fitch Ratings earlier this year when the ratings firm cited concern over bad debt managers' financial conditions. No surprise there. 3 of the companies cited by Moody's were also put on negative outlook. This from Hurong Cinda and Orient Asset. Their asset quality and profitability will remain under pressure due to the persistent strain on China's property market and slowing economic growth, which we note is only going to get worse. And this is actually causing some panic in Washington now, because I want you to think about this from, of course, the government's perspective. Here is, what do we have? Record deficits. And well, what do you have when it comes with that? Well, record debt issuance. And what do you need people to do? Buy it. Who you've been counting on for many years? Well, it probably was China, who for now, quite a period of time, has been selling its treasuries. And lo and behold, what happens? U.S. Treasury team meets with China, as we send Janet Yellen, our Treasury Secretary, over there to talk with the Chinese economy czar, extending their engagement. Of course, what are we worried about? Well, if China doesn't buy our debt, that means, of course, U.S. investors have to buy. And if that happens, well, next thing you know, pulls more money out of the U.S. economy, away from the U.S. equity markets, and we start to find out just how fragile our system is, knowing that, again, the small and mid-sized regional banks are still insolvent. The meeting of the Financial Working Group, as it's been named, included discussions on financial stability and capital markets issue. Of course, the biggest issue of financial stability would be buying U.S. debt against record deficits. Because look, if the world starts to push back on all this government debt being issued, what's going to happen? You're going to see some countries, now the U.S. can't do this, but they're going to end up restructuring a lot of their debt, pushing the terms out, and it's going to force governments to cut their spending at a time the global economy is not just headed into a synchronized recession, but an all-out financial crisis. And this is a big problem for the U.S., who needs to maintain its status here as the world's largest importer. If we can keep our economy humming, maybe we can pull the rest of the world out of it. The problem is we got a lot of debt coming, and we need buyers in a bad way. And here we can see, of course, their focus on international financial institutions, sustainable finance. Of course, that could be cutting the deficit in a big way, but nobody wants to talk about that. Cross-border payments and data and anti-money laundering, and countering the financing of terrorism. Of course, the big thing is financing U.S. government debt. You notice that wasn't written in there, but you can almost better believe they talked about that in a big way. Is Janet Yellen needs to sell all of this treasury issuance, and she needs China to buy it. And right now, they're net sellers. And now you can see, of course, just the cascading effect. The U.S. equity market under pressure by the yield curve, saying financial conditions are indeed tightening. We're seeing Chinese equity markets and economy imploding. All suggest the shockwave could be coming to American shores and send U.S. stocks crashing in the near future. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.